Hi guys, good morning. Hope all of you are doing good. So this is the series, the revision series which we have started, the revision of all the concepts, not important concepts, all the concepts in important chapters. So Forex we have done. If you are watching this video and you haven't seen Forex, I would suggest first do Forex, because we always do Forex first in class and then we do derivatives. So I want you to first cover Forex successfully. We did 100% of Forex concepts in 2.5 hours. In 2.5 hours, everything in Forex has been discussed. So you can understand how potent and effective these classes are. Now we are starting with derivatives, and hopefully I will be trying my level best to cover everything that is discussed in the class without compromise on any concept. But again, I am speaking this as a disclaimer. My videos may be useful, may not be useful for people who haven't studied from me. They might find out of context, they might find things going pretty fast. But if you have done my classes and if you have done 1 to 2 rounds of revision, you will find these classes very, very useful, guys. I promise you on that. Okay, let's start. Derivatives is the introduction part, is what I am starting first. The introduction, if you remember guys, we are going in the same sequence in which we did things in the class. Introduction, if you remember, I told you one thing, that the main purpose of introducing derivatives, the main purpose of introducing derivative instruments is risk involved in organizations. Now there can be innumerable types of risk in the business, but we were mainly interested in 4 types of risk. Keeping your curriculum in mind, we were caring about 4 different types of risk, and then we learned how derivative instruments can play a vital role in protection against those risks. So the main idea for introducing derivatives was to hedge, but then yes, people started using derivatives even for speculative purposes to exploit their belief. Okay, so what are the 4 types of risk, guys? If you remember them, number 1 is exchange rate fluctuation risk. Exchange rate fluctuation risk. And then if you remember exchange rate fluctuation risk, I told you every risk can give you favorable outcome or can give you adverse outcome. It can be a favorable outcome, it can be an adverse outcome. We are not bothered about favorable outcome. Favorable we all invite, but it's the adverse outcome that we are worried about. In case of exchange rate fluctuation risk, because we have already got the knowledge in Forex, so I don't have to spend a lot of time to explain this to you, but in short, I'm telling you what is adverse. Adverse is unwanted movement in currency in respect of another currency. That is, when we are talking about currency pair, we are worried about adverse movement. Like what I'm trying to say, suppose I'm an Indian entity and we have dollar receivable. So we know we discussed like this, receivable is an asset and we are always worried about asset going down. So if you have dollar receivable, you are worried about dollar going down. If you have dollar receivable, you are worried about dollar going down, because dollar receivable is an asset for you and we all are worried about asset going down. On the contrary, if we have dollar payable, now we know payable is a liability and we are worried about liability going up. So this is the adverse movement I am worried about, right? The second important risk that we discussed about was interest rate fluctuation risk. Interest rate fluctuation risk, and if you remember, in our book we have a separate segment where we only discuss about interest rate derivatives, because now this, in the new syllabus, this has been introduced as a new chapter. And interest rate derivatives like cap, floor, collar, like interest rate futures, these are interest rate derivatives, the FRA, forward rate agreements. I hope you remember all this. So interest rate fluctuation risk, again we are worried about the adverse movement, and I told you it's mainly the floating rates which keep on changing. Guys, you remember what are floating rates? I told you floating rates are those rates which will keep changing according to the market rates, and the best floating rates that can be used as a representation are LIBOR, that is London Interbank Offered Rates, and MIBOR, that is Mumbai Interbank Offered Rates. I'll discuss about this later on, but right now we need to understand what am I worried about. So if you are a floating rate borrower, if you have taken a loan at floating rate of interest, then obviously you're worried about interest rates going up, because if market rates will go up, then obviously your loan interest rate will also go up and you will end up paying higher amount as interest, which we will not be interested in. So floating rate loan borrower will always be worried about interest rates going up, because I will have more outflow. And if I am a floating rate investor, like if I invested in floating rate bonds where coupon rate is not fixed, but it will keep changing according to the market rates. So floating rate investors will always be worried about rates going down, because if interest rates go down, you will get less return on your investments. Okay, the third type of risk, if you remember, is that commodity prices fluctuation. Commodity prices fluctuation. And if you remember, we have discussed certain types of commodities like copper, crude oil, gold, wheat. These are the variety of sums which we have covered in the class. And commodity prices fluctuation can be looked upon from two angles. If you are a raw material buyer, then obviously you're worried about prices going up, because if raw material cost goes up, it will impact your profit margins. And if you are a supplier of finished goods, then obviously you're worried about finished goods prices going down, because if finished goods prices go down in the market, I will lose on my profits. And the last was the financial securities exposure. When I say financial securities, I am talking about equity, or I am talking about the equity index, or you might have investment in bonds, or even real estate or gold or commodities, whatever it is. So if you have invested in financial securities, again, you can take two types of position. If you have taken a long position, then you're worried about prices going down. And if you have taken a short position is taken when we are bearish on the market and we are worried about prices going up. You take a short position when you think something will go down in value, but if it goes up in value, then that is a loss for you. Similarly, you take a long position when you're bullish on something, and if the price goes up, that's a favorable outcome for you, but if price goes down, then you will suffer losses. So what I told you is, before you understand what are derivatives, you need to understand why we need derivatives. And one main reason why we need derivatives is because organizations are exposed to different types of risk. Especially we focus on these 4 types of risk, keeping your curriculum in mind. And accordingly, for these types of risk, we are worried about the adverse movement, and against the adverse movement, we need protection. For that protection, derivative instruments are available. Next point is, how many types of derivatives are there? So in the markets where they are available, we can have 2 types of derivatives. It is OTC, that is over the counter, and exchange traded derivatives. I hope you remember this. OTC is mainly the banks will act as the market maker, banks provide the quotation, and in exchange traded, it can be available through BSC or NSE or MCX, that is multinational commodity exchange. For commodities, we have an exchange called as MCX, that is multinational commodity exchange. Banks will provide you mainly forward contracts, which we already studied in Forex. Forward contracts which we studied, you know this, were always available from the bank. So bank will provide the forward contracts, and even the swaps are available through banks, whereas futures, options, and cap, floor, collar, these are available through exchange. They are exchange traded instruments. Now obviously guys, you know this, that in banks, when you go, you have that one-on-one relationship with the banker. There is a one-on-one relationship between the banker and the customer. But when we are doing trading through exchange, the exchange is standing in between us, and the buyer and seller never faces off each other. It's the exchange which is helping two parties meet to do the transactions, but the parties never get to see each other. When I buy from the exchange, for me virtually the exchange is a seller, and when I sell to the exchange, for me virtually the exchange is the buyer. So when thousands and lakhs of people are doing trading through exchange, obviously exchange cannot give you customized contracts. Guys, if you remember, when we were doing forward contracts, I told you this, that it is the best feature of a forward contract is that forward contract comes with customization. You remember that? So the contracts are customized when you go through banks, but contracts are standardized when we go through exchange. And when I say standardization, then I am talking about two important things: standardization in respect of quantity and standardization in respect of maturity. So basically, when we talk about futures or options, we are talking about lot sizes. Lot sizes are defined in case of futures and options, and maturity is also defined. If you remember, I showed you that maturity is 1 month, 2 months, and 3 months. Maximum maturity is 3 months available in India. That's how trading is done in India. But obviously, I told you in exam they can give you more maturity also. but that is not realistic going by our markets. Then I told you further, default risk obviously is high in this case, and default risk is almost nil in this case, because they don't have strict margin requirements, no strict margin requirements. And here the margin is very strict margin. In fact, they have that M2M feature. If you remember, that is, the exchange related instruments are done M2M, that is mark to market, according to the closing values of the asset class. Every day your balances will keep changing, and exchange will keep a vigilant eye on that, and accordingly whenever your margin balances will go down, they will ask you to deposit further margin. Whereas in case of banks also, they do ask you for margins and security deposits, but then they tend to be lenient. Obviously they are lenient, that is why we have the past history of people like Vijay Mallya, Nirav Modi, and so many other defaults which have happened, maybe because the margins were not collected properly from them. But in exchange it does not work like that. You don't have any past reputation or credibility. Whoever wants to do the transaction, there are predefined the margins and lot sizes, everything is predefined. You got to go by that. Okay, so these are some points of differences. So basically, as far as availability is concerned, derivatives can be divided into two types of markets. One is over the counter derivatives and one is exchange traded derivatives. How many types of derivatives are we going to cover in class? We are going to cover these two and these three. Total 5 different types of derivatives we are going to cover. Forward contracts and swaps, financial swaps, they are OTC, whereas futures, options and cap floor collar, they are exchange traded. Now the question is, what are derivatives? So if you remember, I told you the meaning of derivatives is hidden in the word itself, that is derivatives, which is derivatives. Let's say like this, derivatives, which means they derive their value. That's why they're called derivatives. So they derive their value, and the value is derived from the underlying asset. Underlying asset is the asset on which you have the derivative available. That is the underlying asset. Like in case of currency derivatives, currency is the underlying asset. In case of equity derivatives, equity is the underlying asset. And in case of commodity derivatives, the commodity is the underlying asset. So the main important thing you need to understand is, a derivative will not have its own independent value. Its value is not calculated independently. Its value is not determined independently. Its value is actually derived from the underlying asset for which that derivative is available. If you remember, I gave you the example for this for explanation purpose. I explained you this with the help of IRP, where IRP says F is equal to S into 1 plus IA divided by 1 plus IB. If you remember this, guys, F is equal to S into 1 plus IA divided by 1 plus IB, where IA is the price currency, IB is the interest rate of base currency, and here spot currency rate is the underlying asset, and forward contracts, which we know is a derivative. So basically the pricing of the forward contract, is dependent on the spot market quotation. The pricing of the forward contract is based on the spot market quotation, which makes it clear that derivatives are deriving their value from the underlying asset. That is why you need to understand this. If I say rupee per dollar is 69 and 3 months forward rupee per dollar, if I tell you no information is given, if I ask you this question, 70, 100, 135, which one looks correct to you? 3 months forward rupee per dollar looks correct at 70 or 100 or 135. Obviously, logically speaking, 100 and 135 looks to be wrong, because I told you a forward contract is a derivative which derives its value from the spot market quotation. The spot market quotation is 69. So obviously in that case, even derivative value has to be close to the spot market quotation. 100, 135 looks really unrealistic. That's what I'm telling you, guys. Derivatives have their independent value, but then the value in first place has been determined by using the spot market. That is the underlying asset. So that is why they are called as derivatives. That is, they derive their value. Okay. So now we understood what are derivatives, what are the types of derivatives, what risk are we trying to protect through derivative instruments. But then the question is, are derivatives used only for the purpose of hedging? Answer is no. Derivatives are also used for the purpose of speculation. Our curriculum is primarily focused on hedging, but then that does not mean that speculation related sums cannot come in exam. They can give you speculation related sums, and we did cover that in the class. Okay, so these are the basics that we have discussed. Now we will be starting with our first point of discussion, and we will be discussing about the futures. Now, certain things, basic things which we already know: futures are standardized contracts, futures have margin requirements, futures are exchange traded, there will be M2M feature available in futures. Now, what the first important thing you need to understand is, if you remember, we have taken this kind of an example that there is a cash market, there is a future market. Infosys in cash market is available for 620. Suppose if you buy 1000 shares of Infosys in the cash market, how things work in the cash market is, I will have to pay 6,20,000 and I will get delivery in the cash market. You remember this, guys? Cash market, as I explained to you in Forex, is a market which is known as delivery based market. This is a delivery based market. If people are interested to take delivery, if people are interested to become owner of the shares, if people want to stay with the share for as long as they want till they are alive, then they should go in the cash market. Cash market is where you can pay the money, take delivery, and you sell the share, you get money for that. So you get delivery and you transfer delivery in this market. So in this case, the problem is that you got to pay 6,20,000 rupees to buy 1000 shares of Infosys, and you can hold it for any time till the time you get price as per your expectation. Maybe you have a target price of 700 or 750 or 800, and till the time that price does not come, you can continue holding it. There are no restrictions on the time limits till when you can hold your shares in the cash market, because you are a owner, and when you are the owner of something, it is your right to decide when you want to sell it. So in the cash market, what are the advantages? The advantages are, you get delivery, you get the ownership, and you are entitled to dividends, you are entitled to bonus issue by the company, you are entitled to any right issue by the company, you are entitled to participate in AGM, and you are also entitled to voting rights. So this is the cash market. Whereas the disadvantage of cash market is, I only get the shares ownership when I pay 100% amount for that. So 100% in this case is 6,20,000. Only when you pay 6,20,000 you will get the ownership of the shares. Alternatively, what people can do is they can trade in futures. Now, first thing you need to understand is, this is non-delivery based. Very, very, very important point. I cannot overemphasize on it that this market is non-delivery based. You never get delivery in this market. Only thing you do is you take positions, and that is why we have two types of positions. We can take a long position and we can take a short position. When you take a position, you understand the first prerequisite in case of taking positions is that you need to square off your position, and there is a time limit within which you need to square off your position. So when you take a position in the cash market, when you take a position in the futures market, you need to keep in mind that there is a deadline by which you need to create a reverse position. So if you start by taking a long, then you need to reverse by taking a short, and if you first take a short position, you need to reverse by taking a long position. Guys, I hope this part is clear to you. So that is why in futures it is technically incorrect to use the word buy and sell, although we use it in casual language, but actually the word should be long and short, because when we use the word buy and sell, we actually talk about transfer of ownership and rights. But actually in futures, you are never going to become the registered shareholder of the company, because you're only taking a position, and later on you will have to square off your position. Okay, and now what is the advantage of trading in futures, and what are the disadvantages of trading in futures? Let me first tell you the disadvantages of trading in futures. The number one disadvantage is, you are never a registered owner of the shares in the eyes of the company. So you are not entitled to any right issue, no bonus issue, no dividends, no participation in AGM. All these benefits you cannot get. If you want all these benefits, better go to the cash market. Futures people are doing just to exploit their belief, either by going long or by going short. Now obviously, when will you go long? You will go long when you're bullish on the stocks, and you will go short when you're bearish on the stocks. So obviously, if you are bullish on Infosys, you can go long on Infosys, and if you are bearish on Infosys, you can go short on Infosys, knowing clearly that at some point of time in future you need to square off your position. Right now it's the month of April. If I today open the futures details of Infosys, I will find there are 3 trades available. One is for the month of April, one is for the month of May, and one is for the month of June. 3 different future contracts will be available in the market: April, May, June. I repeat, in exam they can give you 6 months, 12 months futures also. So please do not challenge the institute. They can give you just understand that they can give you any maturity in exam, but practically we know there are only 3 futures available: April, May, June. These contracts, they start on the first day of the month and they carry on till the last Thursday of the month of maturity. If Thursday is a holiday, you need to square off on Wednesday. Okay, so suppose today if I take a contract for June end, so if I take a long on for June end, and let's say the cash market price was 620 and futures price is 630. Let's say 630 is the price of futures, which means before last Thursday of June, at any point of time I can square off my position. Okay, if I call up my broker and tell him that okay, I want to take one future of Infosys and I need 1000 shares, my broker will check and he will tell me that no sir, Infosys futures are not available for 1000. Standard lot size in case of Infosys is 1200. Standard lot size, you can go and check the money control app guys, actually it is 1200. So if you want to trade, you can trade in either 1200 shares or 2400 shares or 3600 shares. That is in a multiple of 1200. That's why sometimes lot size is also referred as multiple. So in this case, even if you wish, you can't take 1000 shares, you got to take 1200 shares, which means the value of the contract is 1200 into 630. That is the total value of the contract, which is going close to 7.5 lakhs. Okay, this is, let's say this is 7.5 lakhs. Okay, don't start calculating and telling me that sir the figure you calculated is wrong. Please, I'm taking a hypothetical figure, that's why I've written the word say over there. Value of the contract is 7.5 lakhs. Now this is where the advantage of derivatives will come in, because you are only taking a position and you're not getting ownership. Unlike the cash market, here you only have to pay initial margin, and let's say that initial margin is 30%. Sir, who decides the initial margin? Clearinghouse will decide the initial margin. Sir, who is the clearinghouse? Clearinghouse is one of the entities of SEBI. You can understand like this: between SEBI and brokerage houses there is an entity called as clearinghouse, and clearinghouse will define what is the lot size, what is the margin to be paid, and how much is the initial margin, what is the maintenance margin. So maybe in this case you have to pay 30%, and let's say that is 2 lakhs, which means in this case the trader or the speculator can pay only 2 lakhs and he can take a position in 1200 shares of Infosys. That's the beauty of futures. That is the beauty of futures, but that is also the dangerous part of futures, because you are actually doing a position which might be beyond your risk appetite. Because if I tell you to pay 7.5 lakhs and take delivery of 1200 shares, you will have to think 10 times, because you need to take out of your pocket 7.5 lakhs. On the other hand, if you only have to pay 2 lakhs and you can take a position in 1200 shares, definitely anybody would love to take that trade. That's a very good trade, because you only pay 2 lakhs for taking a position in 1200 shares. Now suppose you took the position at 630, and by June, last Thursday, anytime you can square off your position. But let's say tomorrow itself the price becomes 640. Now obviously you will be happy in that case, because you are taking a long position at 630 and you were betting on upside movement, and actually the upside movement comes. So there is a profit in this case. 640 minus 630 into one lot size is 1200, which means in a day you have made a profit of 12,000 rupees. Which is actually a very good amount of profit you have made. So obviously it's an unrealized profit, and it's a choice. If you want, you can continue holding your position, and if you want, you can square off your position and make a quick return of 12,000 rupees. But exchange cannot pressurize you to square off your position. Exchange can only ask you to square off your position on last Thursday of June and never before that. Yes, there is one exception. If the price starts going down, then in that case exchange will not allow you to continue holding this position without depositing the margin money. So what they do is they define something as maintenance margin. So suppose maintenance margin is 60% of initial margin, which means 2 lakh was the initial margin deposited by you, and 60% of that is maintenance margin, which means if your margin goes below 1,20,000, if your margin balance based on M2M goes below 1,20,000, which means if you suffer a loss, unrealized loss of 80,000 on this position, then your margin 2 lakh is the margin you deposited initially, that will reflect in your demat account. Now what happens is if tomorrow it goes down by 20,000, so 2 lakh will become 1,80,000. Next day it goes down by 15,000, 1,80,000 will become 1,65,000. Next day again it goes down by 15,000, 165 will become 150. That's called M2M, mark to market. According to values changing in the market, everyday margin balance will be adjusted either upside or downside. If it goes down to 1,20,000, then there is a variation margin call that you're going to get from the exchange, and it's like a red light, red buzzer which will start blinking, and that's actually a bad news for us, because in that case your exchange will call you up and they will tell you, actually nobody is going to call you up. Nowadays things are all electronic. You will get a message that your margin balance has gone down, please provide sufficient funds so that you can continue with your position, and if you fail to do that, then they will square off your position, and whatever loss you have suffered becomes your realized loss. So if suppose my balance of margin comes down to 1,10,000, then theoretically you need to deposit enough money, which is referred as variation margin. You need to deposit enough money to bring your margin balance back to the level of initial margin. Okay, so this is how futures work, guys. I hope you are able to recall all the concepts. Let's just recall quickly. Cash market is delivery based, futures are non-delivery based. Futures, we don't buy or sell, we take positions. Long position when we are bullish, short position when we are bearish, and lot sizes are defined, maturity is defined. You initially pay initial margin and then you can continue with your position. What is the position? Carry forward limits, time limits up till last Thursday of the month of maturity. And yes, if you want, you can square off early also, but last Thursday of the month of maturity, by default your position will be squared off. There is a maintenance margin limits given, where maintenance margin is calculated as a percentage of initial margin. If your balance ever goes below maintenance margin, then you need to deposit variation margin to bring the margin balance back to the level of initial margin. I hope, guys, this is clear to you. After that, the next point of discussion is that in case of futures, sometimes the initial margin will not be provided to you, and in that case, if initial margin is not provided to you, then you need to use a formula, and that formula is given as mu plus 3 times of standard deviation. Standard deviation, you know, is the deviation of the actual values from the average expected value. Deviation of actual values from average expected value is known as standard deviation. Mu is the average of daily absolute change. These values will be given to you. You just have to put it in the formula and calculate the initial margin by using this formula. So you take it as mu plus 3 times of standard deviation, average of daily absolute change in the value of the stock, whatever is given, that is mu, and standard deviation is deviation of actual values from average value, and you take 3 times of that. So mu plus 3 times the standard deviation, that is the formula for calculating initial margin. Now remember one thing, the short which you take on futures, suppose you think Maruti right now is trading at 5,300 and you think it will come down in value. So suppose you think it will go down to 4,700 and you take short, that is F minus on Maruti at 5,300. Lot size for Maruti is 100 shares. You take a short position today, and let's say you have taken 1 month. So April last Thursday is the day by which you should square off this position. How you need to square off this position is by taking F plus, that is a long position. You need to square off your position by taking F plus, that is a long position. Now you need to understand, guys, if you remember in equity analysis, I told you that in cash market people can do short selling. I made certain videos and posted on YouTube about it. But short selling in cash market is completely different from short position in futures, because cash market short selling which you do it at 9:15 in the morning, and by 3:30 you need to square off your position. That is, you sell something in the market without having ownership, and before market closes you need to take ownership. That is short selling. Short selling is done in cash market, but short position is taken in futures, and short position can be taken forward up till the time maturity of futures come, which means there is no restriction on the time limits of short position. You can continue holding it till last Thursday of the month of maturity. Now obviously from 5,300 two things can happen. It can become 5,500 or it can become 5,000. Obviously if it becomes 5,000 you will be happy, and if it becomes 5,500 you will be sad and you will suffer loss of 200 rupees. Lot size being 100, taken one lot, 200 into 100 is 20,000, which is your total loss in that case. If it goes down by 300 and you square off your position, 300 into 100 is 30,000, that is your profit. Obviously when you take a short, it means you are bearish on a stock and you are betting on downside movement, but suppose if stock goes up, then there is a loss for you. Okay, this is the basics of futures that we have discussed. After that, guys, we discussed something very important, that is how hedging transaction exposure through currency futures. Hedging transaction exposure through currency futures. If you remember, I told you there are 3 steps for this. Step 1 is to decide whether to buy or sell futures. Whether to buy or sell futures, that is step number 1. Hedging transaction exposure through currency futures. You know, we already learned transaction exposure can be hedged through forward cover, money market cover, netting, and home currency invoicing. These are the 4 main strategies we have discussed. 2 more strategies are left. One is currency futures and one is currency options. Step 1 is to decide whether to buy or sell futures. I told you that before you decide whether to buy or sell futures, the first thing you need to do is need to answer 2 questions. Question number 1 is, what is my risk? Learn how to define your risk. If you learn how to define your risk, half the strategies in entire derivatives become a cakewalk for you. So first thing you need to answer is, what is my risk? How futures can be used to enjoy risk. How futures can be used to enjoy risk. These are the 2 questions you need to answer. What is my risk and how futures can be used to enjoy risk? These are the 2 things you need to answer. If you are able to answer these 2 things, you will always get correct answer. Let's see a few cases on this. Case number 1. Indian entity has dollar payable. Now what they can do is, they will either give you rupee futures or they will give you dollar futures. Indian entity has dollar payable. Either they will give you rupee futures or they will give you dollar futures. Guys, first of all, Indian entity has dollar payable. Define the risk. If we have dollar payable, payable is a liability, which means we're worried about liability going up, which means we're worried about dollar going up. If you're worried about dollar going up, do something with dollar futures, that if dollar goes up, at least on derivatives we make a profit. So the only way to make profit by upside is by taking a long position. I repeat myself, we have dollar payable. Payable is a liability. We are worried about liability going up, so we are worried about dollar going up. So obviously in this case, if dollar goes up, we will suffer loss in the cash market because we will end up paying more rupee in that case. So do something with dollar futures, that if dollar goes up, we still make profit from it. Only way to make profit from upside movement is by taking a long position. So in this case, you should go long on dollar futures. And if we are worried about dollar going up, that automatically means we are worried about rupee going down. If we are worried about dollar going up, it automatically means we are worried about rupee going down. If rupee futures are available and we want to enjoy the downside movement, then we should go short on rupee futures. Guys, please tell me, am I making sense? Are you able to understand and recall everything that we have discussed in the class? Okay, so if rupee futures are given, we will go short on it. If dollar futures are given, we will go long on it. Nothing to learn, guys, nothing to learn. We are going to understand everything and study. That's the beauty of the subject. If taught properly, people need not learn anything in this subject. Okay, next, case 2. US entity has pound receivable. Too much of rupee dollar we are doing. Let's see if this is where you can apply your mind. US entity has pound receivable. You can think about it. First, then I will speak. Dollar futures are given, pound futures are given. Any one will be given. That's why I'm writing or in between. Either dollar futures or pound futures. Sir, very simple. Pound receivable. Receivable is an asset. We are afraid of asset going down, so we are worried about pound going down. If we are worried about pound going down, we should do something that if pound goes down on pound futures, we make money. Only way to make money by downside movement is by taking a short position. We have pound receivables, we are worried about going down. So if pound futures are given, we'll go short on it. If you're worried about pound going down, we are also worried about dollar going up. So if dollar futures are given, then we will go long on it. Clear? So this is your step 1, guys, where you decide whether to buy or sell futures. Step 2 is number of contracts. I hope you remember this number of contracts. We have done 2 cases. If same currency exposure and lot size are given, then number of contracts is simply exposure by lot size. If same currency exposure and lot size is given, then we simply do exposure by lot size. Both are in dollars, so simply you take exposure by lot size. And if different currencies exposure and lot size is given, suppose exposure is given in dollars but lot size is given in rupee, then obviously division is not possible. Then what we do is we convert dollar exposure into rupee equivalent exposure, rupee equivalent exposure, and you do it at future price. At future price, whichever future you're going to use, you convert your dollar exposure into rupee equivalent exposure at that future price, 3 months, 4 months futures price, whatever you are going to use, and then you divide by the lot size. Okay, so if exposure and lot size are in same currency, simply go for division. If exposure and lot size are in two different currencies, then you first convert your dollar exposure into rupee equivalent using future rate. Guys, don't make a mistake. You need to convert it into rupee equivalent exposure at future price, not spot price, and then divide by lot size. Two important things, guys. One is that lot size is a very good indication of what currency futures are available. Which means if dollar lot size is given, it means dollar futures are available. Some questions are not very clear about whether dollar or rupee futures are available. Always target lot size. Look at the lot size and decide what futures are available, which means if lot size is given in rupee, it is rupee futures. If lot size is given in dollars, it is dollar futures. Point number 2 is imperfect hedge. Imperfect hedge. Many a times you will get answers like 13.45 or 13.78. This is the kind of answers you might get. The answer for that is very simple. The reason for that is very simple, because futures have standard lot sizes. So it will not be able to provide us a perfect hedge. That is, there will be some difference. So what generally I recommend is that you take one lot less, which means if you get 13.45, you take 13. If you get 13.78, you take 13. You can take 14 also in case of 13.78, but I personally prefer rounding it down. Why, sir? Why do you prefer rounding it down? Because every time you take extra future lot, you will have to pay margin for that. There is cost associated with taking more contracts. So you always prefer to under hedge by taking one less contract. That is rounding it down, not rounding it up. Okay, so 13 contracts I will take. But now the important thing is, sir, whatever we have ignored is okay, but sometimes in question they might tell you that in respect of unhedged portion, we will take a forward cover. Then what we do is, suppose lot size is 20,000. So what we do is 13 lots you have taken, which means 13 into 2 is 26, which means only up till 2,60,000 of exposure we have been able to cover. 20,000 is the lot size in dollars. You have taken 13 contracts, so 13 into 20,000 is 2,60,000. Then 0.78 you have ignored. Suppose the total amount payable was 2,68,000, which means out of $2,68,000, 2,60,000 has been hedged using the forward cover, which means the balance is 8,000. For this 8,000, guys, we will take a forward cover. That's what we do only when they specify in the question that any unhedged portion should be hedged using a forward cover. So whatever number of contracts you are taking into lot size will give you total exposure covered through futures, and whatever is the difference, keeping your payable and receivable in mind, for that you will take a forward cover. I hope, guys, I am making sense. Okay, so and then the last step number 3 in our discussion, we have 3 different things on maturity. The first thing is profit or loss on squaring of futures. We calculate whatever is profit or loss on squaring of futures. Number 2, you settle your payable or receivable in spot market. And lastly, step number 3 is, if in futures any margin is paid, then we calculate the interest on margin blocked. If in respect of futures you have paid any margin, then we calculate the interest on margin blocked. These are the 3 things you do on maturity. So 3 steps, guys. Step 1 is to decide whether to buy or sell futures, and for that you need to answer 2 things in your mind: what is my risk and what futures position can help me enjoy the risk. Number 2 is number of contracts. If same currency exposure lot size, simply divide. If exposure and lot size are given in 2 different currencies, then you first convert your exposure into lot size currency by using future rate and then divide. If you get imperfect hedge, round it down and ignore the unhedged portion. But sometimes if they specify that unhedged portion is to be hedged through a forward cover, then first find out by rounding down. Number of contracts, 13 is taken. Each contract lot size is 20,000, which means you are able to hedge 2,60,000 worth of dollars through futures. Suppose total invoice value is 2,68,000. The balance of 8,000 will be hedged through the forward cover. And on maturity, 3 things will happen. The profit or loss on squaring of our futures is calculated. Then whatever is the payable or receivable, that we settle in the spot market. And if there is any margin paid on futures, then we calculate the interest on that margin for the period of future maturity. This is one of the most important topics in exam, and this topic is tested almost like 3 out of 4 attempts. Every 3 attempts out of 4 attempts this topic comes in exam. The frequency is very high, it comes for around 8 marks, so we should be able to score 8 out of 8 in this, and the kind of sums I've done in class, one out of those sums will come. I'm very sure about it. Okay, apart from that guys, another important thing you need to understand, the main difference between forward cover and future cover is forwards are very simple. Number one, they are customized contracts. No maturities are defined, no lot sizes are defined. You can take the contract for any amount. So there is no question of imperfect hedge over there, because you get forward contracts for whatever amount you want to take. The second biggest advantage of forward is you go to the bank and you get delivery of your currency. However, it's not so in case of futures, because futures ultimately you will be going to the spot market for settlement. Futures are only squared off for profit or loss, and in the actual settlement is going to happen in the spot market. But it's not like that in case of forward cover. Once you take a forward cover, you will straight away go to the bank and settle at the predetermined rate, the rate at which forward cover was taken. That is the advantage of forward over future. But that does not necessarily mean that forward cover will always give you financially a better answer. Financially, you might end up having a better answer in case of futures. So we can't say forward contracts are better, but we can say forward contracts are more convenient when compared to future cover. Okay, so this part is over. Similarly, if you remember, we discussed, just like I taught you equity hedging, currency hedging. Similarly, we can have commodity hedging, and we can also have equity hedging. If you want to hedge these two using futures, hedge using futures. Okay, commodity, very simple guys. Suppose you are wheat producer, or you are crude oil buyer. In case of commodity market, either you are a wheat producer or you are a crude oil buyer. We're talking from two different perspectives. Producer will produce the wheat and sell on a future date. So obviously wheat producer is afraid of, he's a supplier of finished goods, and for him it's a finished goods, so he's worried about price going down, because obviously if you are a farmer and you are producing wheat, you would like to sell your wheat production at a higher price, not at a lower price. So if you're a wheat producer, you would like to sell wheat at a higher price, so you're worried about price going down. So if you're a wheat producer, the first thing you do is exact 3 steps guys you have to follow, like what you did in case of currency futures. Step 1, what is my risk? I am worried about wheat prices going down. Do something that if wheat prices go down, you still make money. So what you will do on wheat futures, you will take a short position, because you're worried about prices going down. So you will do something with futures that if price goes down, you still make money from it. So if you are a supplier of finished goods and you're worried about wheat prices going down, then on wheat futures you will take a short position. Second step you will do is number of contracts. Number of contracts is simply exposure by lot size, and step 3 is again the same. You will calculate the profit or loss on squaring of wheat futures, and then step number 2 is that you will settle your position in the cash market. That is, whatever wheat you need to sell, that you will sell in the spot market. Very, very important to understand one thing is that never settlements can take place through future contracts, because futures are non-delivery based. That's very, very important. If you are a buyer of crude oil, then in that case, you are worried about prices going up, and in that case you will be worried about prices going up, and in that case crude oil futures you will go long, because you're worried about prices going up. So you do something that if crude oil prices go up, you should make money from it. So a crude oil buyer should buy crude oil futures, and obviously again the same thing, number of contracts is exposure by lot size, and then on maturity you will buy crude oil in the spot market, but on the crude oil futures will be squared off in the futures by taking a reverse position. And next thing is equity. Suppose equity cash market, you have taken a long position, that is you have a buy position in cash market, or you have a short, which means basically it is short selling. Equity cash market, if I have a buy position, then obviously I'm worried about prices going down. Suppose in cash market I have purchased Reliance. If in cash market I purchased Reliance, so obviously I'm worried about Reliance prices going down. So how do I hedge? What is my risk? I have a buy position on Reliance and I'm worried about Reliance prices going down. What can I do to protect myself. If Reliance futures are available and I want to protect myself from falling prices, then I will go short on Reliance futures. Short on Reliance futures. Are we clear about it? If we have taken a buy position on Reliance, then we are worried about Reliance prices going down, and accordingly we will go short on Reliance futures. Similarly, if we have taken a short position, suppose my same example, Maruti, I have taken a short selling position in the cash market, then obviously if I have taken a short selling position, I am worried about, I'm betting on downside price movement, but I'm worried about prices going up. If I'm worried about prices going up, I should do something with Maruti futures that if price goes up, I can still make profit. So on Maruti futures, I will take a long position. On Maruti futures, I will take a long position. Okay, so what are the topics we have discussed today? We have discussed about the introduction of derivatives. We have discussed about the fundamentals of futures, that is all the features of futures. Then we have discussed about hedging the currency risk using currency futures. Then we have learned hedging the commodity risk using commodity futures and hedging equity risk using equity futures. I will continue with the discussion. We will need one more class on futures that we will discuss in our second class of derivatives. Thank you guys. Bye bye. Hope you enjoyed the lecture. Thank you. Bye bye. God bless.